Afternoon, everyone. Thank you so much for joining us today. My name is Maria Asher, and I'm a co-portfolio manager on Westwood Select Equity and Dividend Select Strategies. Today, we wanted to take this opportunity to talk about our outlook for the market, where the markets have been. For that, we have Leah Bennett and Matt Lockridge joining us on the call as well. Leah is the president of Westwood Wealth Management, and Matt is a senior vice president and the head of our US value team. Hi, Leah and Matt. How are you doing?
Doing great.
Well,
Thank you so much for joining us. So we have lots to cover, so let's get started. My first question is obviously about markets. So I don't think I'm wrong to say that markets have defied all expectations. We just closed July and earlier this week, and this has been the best 7-month performance for S&P 500 index since 1997. So can you please recap the markets for us and what has been the biggest drivers? Matt, you can go first.
sure. Thanks, Mara. Yes, you're right. It's been a surprisingly strong start to the year. Obviously, this comes right after a very difficult year for both equity and bond markets last year, with the S&P down roughly 18% last year. So seeing a nice bounce. From a leadership standpoint, large caps have led smaller companies so far this year. And really up and down the market cap spectrum, growth has outperformed value, which is really the inverse of what we saw last year. From a sector standpoint, what's really been driving markets is technology, first and foremost, with a lot of the artificial intelligence euphoria that's in the market. Consumer discretionary as well, but not as much retail as you're really seeing the Amazons of the world. Home builders, for example, are doing very well. And then communication services with some of the social media names. And on the flip side, what's lagged so far this year are really, in our view, some of the interest rate sensitive areas when you think of utilities and real estate and some of the more defensive areas like consumer staples. So it's definitely been a risk on start to the year, and we'll see what the second half brings.
Yeah, and I mean, I agree with Matt's points. It's interesting. I think when you look at the return of the broad indices, it looks like the whole market's done relatively well. Whenever you see the Russell 3000 up 15-16%, you would say, hey, this has been a pretty good year. But the market's been really narrow. So we, in the past, during the pandemic, people talked about the FANG stocks. Now it's the Magnificent Seven. So it's Apple, Amazon, Meta, NVIDIA, Microsoft, Tesla. You've got a handful of stocks that have accounted for 75% of the move in the S&P 500. So a very narrow market. And you've even have the leaders, the large companies, large growth companies have become so large, they're really dominating the composition of the indices themselves. So if you look at the Russell 1000 growth, for example, two stocks comprise over 20% of that index. So it's really interesting as we look forward to think about where things are going to go from here, and even to think about what happened earlier in the year. If you think about Silicon Valley Bank and the collapse of First Republic, which I think would have been a big deal in a market that isn't like today. I mean, people have kind of forgotten that that even happened, and you certainly don't see it reflected in the market. So I think it'll be a great conversation to think, is the market going to roll over? Are we going to have a correction? Or are we going to broaden out and see better participation from some of the laggards?
Yeah, the narrowness point is such an important one because we're seeing the exact same thing. We were looking at statistics, within the S&P 500, only 12.5% of names have been outperforming over the last 3 months. And the last time you saw such a narrow market was the tech bubble. And so we look back and we, wanted to study, okay, well, the obvious question is what happened next after the tech bubble? And really what you saw work over the next 3 years was quality. Those businesses with high returns on capital that generate free cash flow, that have conservative balance sheets. So I think it's important to continue to skew into good businesses that if we start to see that narrowness break, you're in a good position with quality companies.
Yeah, and I think you're exactly right. I think people have kind of forgotten a little bit about balance sheets and about quality and how important that is. It's been such a thematic type of market this year. AI is certainly, artificial intelligence is certainly all the rage. A lot of these thematic trends, which I do think are secular, but they have just dominated. And there still are a lot of risks that are present. And thinking about quality and balance sheets is just critical.
That makes a lot of sense. And I think just to dig deeper into growth versus value spectrum, as Matt mentioned, it has been very narrow. If you think about growth's outperformance, it is the third largest outperformance. The other two were just before the dot-com bubble or during 2020. So are you all concerned about the valuations within the growth segment of the market, or do you think there's still some opportunity that lies there?
Yeah, you're right. We're definitely starting to see some exuberance come into the market in technology, specifically around artificial intelligence. And, we are actually very bullish on the long-term upside from artificial intelligence. It's really going to be a productivity and efficiency driver across corporate America. But this is a long-term theme. And we're noticing that there's a number of securities in the market that are being priced as if all the benefit will come today. And we own in several of our portfolios one of the leading technology strategy consulting firms. And if you listen to what they say, only 10 to 20% of the corporate world is ready to start that AI journey, and that there are steps that you have to put in place before that around data warehousing, basically preparing all of your proprietary information to start this transition. And that's what they're working on with clients. So it's early days, and this is really a decade-long theme. And so you need to be careful in some areas that are priced as if, like I said, it's all going to hit their P&L today.
Yeah, so if you look at growth last year, it really got hit with interest rates going up. So whenever interest rates go up, the present value of cash flow goes down. And so growth stocks really underperformed last year. Some were down, anywhere from 30 to 50%. And so seeing a nice rebound makes sense that we've seen this year. But I agree with Matt's points. I think it's some of those stocks have gotten to a valuation where they're really optimistically pricing in what the future cash flows are, and valuations are quite stretched. And these are secular themes. These are long-term true innovation that can be applied to many other industries as we're coming out of COVID. So again, we've kind of talked about a few of these, but I love looking for examples of, like, restaurants, for example, that are utilizing robotics, and they have better operating leverage than they did pre-COVID. So there's lots of ways you can look at this technology and apply it to companies that haven't really moved, and find companies where you think the operating leverage or the earnings potential is a lot better than what Wall Street is really estimating. And I think that's kind of a sweet spot for us is looking for those type of companies. So yeah, growth is pretty expensive. And then the other thing I did want to mention, in a lot of our portfolios, we allocated towards growth in January, and then we have reduced our allocation to growth. And so we've reflected that in our asset allocation moves as well.
That makes a lot of sense. Thank you for the insights there. So now let's talk about what the market is telling us and the economic data that we are getting. Markets is all happy, up 20%, 19%, an average index. On the other hand, if you look at the yield curve, it has remained inverted since I think September of last year. Traditionally, the inversion of yield curve has been the biggest leading indicator for an upcoming recession. If you look at the PMI data, it remains in the contractionary territory. So can you help us understand this disconnect between what these data are telling, which is like flashing red light for an upcoming recession, and then on the other hand, markets basically ignoring that data?
Yeah, you're right, Maria. I mean, mixed signals from the economic indicators, to say the least. The yield curve, to your point, is as inverted as it's been since the 1980s, and we do look a lot at the manufacturing PMI as an important indicator for our fundamental work. And the reason for that is if you think about, that index, it's basically surveying industrial purchasing managers about what they're seeing real time on the ground in their businesses. So are orders going up? Are they hiring? What is pricing doing? What's inventory doing? Are they seeing more orders than they did last month? And so it is probably one of the best indicators on the trend in profit growth. And so that is just so important, obviously, as fundamental investors. And so it continues to be in contraction territory. We just, got the July figure very recently. Again, new orders and the total index contracting. And we have seen, 3 straight quarters now of negative year-over-year profit growth. So we are in an earnings recession, even if we're not in a technical economic recession. So, year to date, the returns in the market have been driven by multiple expansion, not earnings growth. And so to us, it's investors shifting out on the risk curve and bidding up multiples. And we're also seeing this in the fixed income markets. When you look at credit spreads, high yield spreads were over 500 basis points to start the year. Now we're down to about 435 basis points. You're seeing this in the VIX index, that preference for risk. And so the obvious question is, well, why, if things are bad economically, why are we seeing this type of tolerance or preference even for risk? And to us, it's because the market is sensing a risk has lessened. And that risk to us is the risk that we are in a Fed-induced hard landing. So as we've seen CPI and other inflation indicators start to come down, that's the market insinuating that, okay, the Fed will not have to continue putting their foot on the brake and run the economy into a very deep recession or hard landing. And that they're truly making progress in that soft landing category for the economy.
Yeah, and I think the market really is pricing in a Goldilocks type of scenario, and just the odds that plays out are fairly low. So again, I think just being risk aware is something that is critical. Why things haven't played out the way that you would expect during the cycle, I really think you have to get into some of the supply and demand imbalances that were created during COVID. So again, if you think about with interest rates being as high as what they are, you would think the housing market would be weak. And part of the reason the housing market has held up as well as it has is during COVID. If you guys remember when lumber prices were as high as what they were, you had all these input prices exceptionally through the roof. You had people who were like home builders who said, I'm not going to build anymore. And so that's led to some of these imbalances and kind of created an imbalance between supply and demand. And same with the labor force. I mean, you had the ADP report came out today. It was again stronger than people expected, and in particular, it was strong in the leisure industry and the hotel and leisure. So it's you really have these supply balances that we haven't completely worked through, and I think as we continue to work through them, you will see further weakness probably in the economy. I also think you might have a situation where interest rates stay higher for longer, which will create a lot of stress for companies who are reliant on the financial markets to roll over their debt. So I think there's several places where there's risk, and we may not quite have that Goldilocks type of landing.
Yeah, and I think that's what alludes to Matt's point as well, is having, at the end of the day, why quality is so important is as long as you have a strong balance sheets, companies have a stable debt, generating enough cash flows, they can weather any kind of an economic environment, whether the economy is expanding or, it's contracting. So let's talk about the news that broke last night about the US debt was downgraded by Fitch. Last time when when it happened, it was back in 2011, it created a lot of volatility in the market. So I wanted to hear your all's thoughts on, do you think it's going to cause significant volatility? Is it something that you are concerned about? Should our clients be concerned about it?
Sure, I can start, and you're right.
Mhm.
The last time we saw this in 2011, we did see about a 15% pullback in the S&P. So it's very likely we see additional volatility in the market like we're seeing today. And our initial reaction was that it makes sense. We are in a rising rate environment, so debt issuance is more costly. And there are a number of programs that we have, social programs, long-term issues that we are not addressing. And so it's understandable for the rating agencies to start to take this stance. From a company-specific standpoint, the first thing we thought about was, would this change any type of capital level requirements within the large banks? The reason why that's important is because if they have additional requirements that would cause them to reduce lending even further, that would be a dampening effect on the economy. Today, we don't think that's going to be the case, that this alone would not change the capital requirements for the largest banks, but it's something we're clearly monitoring, and I'm sure we'll get talked about more and more as we go through this period.
And to me, it's just a reminder again about where interest rates are and about debt in general. And so, even if we go back and look globally, since the financial crisis, there's been a massive amount of sovereign debt created. And since COVID, all these stimulus programs are catching up with everyone, not just the U.S., but certainly outside the United States as well. And the two things that I always think about, I think China has accrued 2/3 of the debt that has been generated since the financial crisis, and then obviously we've put on debt, Europe's put on debt. But when you have the two largest consumer countries in the United States, in the world, the U.S. and China, more levered than what they have been, that certainly will have an impact at some point. So to me, it's just a reminder about a risk that's been out there for a while. Certainly you see the market selling off, but I don't think it's anything brand new that's happened, but it's further awareness.
Yeah, and Leah, just to follow up there, I think that is something that, that worries our clients more than anything else. And it's about the growing US debt. What do you think? Do you think it's going to cause any material long-term negative impact on the markets or how the clients' portfolios are invested?
That's a great question. So as far as how our clients' portfolios are invested, it's always important to invest according to everyone's financial plans in general. So it's a great time to visit with your advisor. In general, when we're talking about positioning the portfolios and the investment strategies itself, I mean, I think it takes a longer period of time for the increased leverage to play out. But again, you can't have the two largest levered countries in the world delevering without having a global impact. And we are intertwined. I know so much in the news we talk about the U.S. versus China. We're intertwined, right? Any of these multinational companies have exposure to both. So it is awareness that we've got. It is something we think about from a risk perspective, but it's not something I see having a huge impact over the next 24 months, as an example.
Julia, that's super helpful. And that's what we encourage our clients as well, as Leah mentioned, is that, think about what your objectives are, and that's, think about your goals, work with our financial planning team so that, we can invest accordingly. So now let's shift our focus to inflation. Inflation is something that we have talked about a lot and continue to talk about. Obviously, good news is that inflation appears to be easing. After all the aggressive rate hikes that the Fed Reserve has done. But one thing that I think some of us are now starting to worry about is if you look at the recent data, a lot of commodities prices are rising since the end of June. Think about copper, grains, wheat, oil, everything is up. So Matt, do you think it will cause a material impact on inflation? Are you worried that we might see a surge in inflation?
It's definitely something to be mindful of. Some of the commodity prices that you're seeing rise, like copper, would be a signal that economic growth, at least economic expectations, are improving. But it is concerning because it will definitely give the Fed more ammunition to keep rates higher at the very least, if not continue to raise them. And so when you have high interest rates and now you're seeing a recent move up in gasoline, that's just added pressure on the consumer. And historically, if you look back over the last few cycles, when interest rates are already high and then you see a move up in gasoline, that's often been what has tipped us into a recession. If you think back to 1990, 2000, 2007, it's that move in gasoline that really tipped us over. So, it's something to monitor. And Leah mentioned something earlier on, the effects of having to refinance. To us, that's really one of the bigger risks right now. If you look at the yield curve where you have the short end higher than the long end, that's the market saying that we have high interest rates today, but very soon they will be low again. And if that's not the case, if interest rates do stay higher for longer, you have a number of corporate institutions, a number of real estate institutions, and a number of consumers that will have to refinance. Right now, they're termed out 5 or 7 years. But if we have to refinance at these higher rates, that's where the pain starts. So if we don't get back to low interest rates soon, that becomes a real risk that I think you'll start to see across the economy.
And that brings up a really good point because over 60% of the GDP in the U.S. comes from the consumer, and the consumer has been very strong coming out of COVID. Again, largely because of all these stimulus programs. And eventually, as we're working through cash that has been saved, things like higher gasoline prices will have an impact on a lot of individuals. So I think that's a really good point that we have to continue to kind of monitor. And I do think at the minimum, we're probably in a period where we're going to have higher rates for a longer period of time, and probably different than what the yield curve itself is projecting. Which is basically that we're going to have cuts.
Yeah, thank you. That makes a lot of sense. So I think my last question is, it encompasses all of the conversation that we have had today, and between Matt and Leah, between the two of you, you run multiple strategies, or the teams within you run multiple strategies and portfolios for our clients. So given everything that we know, how are you both positioning your portfolios?
Sure, I can start. We've talked a lot over the last few months and quarters about balance, how you really want to have a portfolio that has a mix of longer term secular themes. There's some areas with economic sensitivity, some cyclicals. You want some ballast in the portfolio. And, I don't want to sound, I feel like I'm sounding very, doom and gloom on the economy. We're talking a lot about risks, but there is a lot of opportunity. And I would say one of the things we've noticed over the last couple quarters are, really good companies, they don't stand still. Their management teams adapt and they pivot and they start new strategies. And one of the things we've noticed is a real focus on cost takeout. And why that's so important is because as they get more efficient and free up additional cash, they can make important strategic acquisitions, or they can return cash to shareholders. And so dividend growth very well may accelerate. The potential for further buybacks may accelerate. And so there are continue to be opportunities across the areas that we're looking at for companies that, whether economic growth is high or low, they will be able to grow through this. And so it's giving us a lot of excitement as we look ahead.
Yeah, I agree. As I reflect on our conversation, we've mentioned quite a few risks that are present. I do think the economy is decelerating at a slow rate, and so there are nice opportunities to make some changes. I mentioned earlier, some of the strategies are reducing their exposure to risk and to growth, and from an asset allocation perspective, we've also done that. We've reduced our domestic growth exposure, and then where should you be allocating money? And so how we've been thinking about what is attractive at this point is definitely international, and I would say developed international is an area that is interesting as you think about the dollar depreciating. So we're closer. Hopefully we're closer to peak interest rates, and so as the dollar comes down, international markets should be interesting. I do think emerging markets, despite the comments about China, are interesting. So if you look outside China, look at the growth in India. There's so much outsourcing in India, and if you think about the next wave of growth from some of the tech companies, it will likely be India. We're also extending our duration in our fixed income portfolios. So I think there's lots of ways that you can pivot in this environment and do well. And then I know we touched on this earlier in the conversation, but I think finding value type companies that have been growing at a slower pace that can utilize technology differently and really increase their operating leverage and earnings moving forward are also really interesting. So there's lots of places to deploy cash at this point.
Thank you. That makes a lot of sense. And I think this is, again, what we remind our clients as well is that focus, if you're a long-term investor, a near-term volatility in the market generally creates buying opportunities. So that's what we should focus is on our goals and if our allocation is aligned with our goals as well. So thank you so much, Leah and Matt, for your insights. It was really helpful. Thank you, everybody who joined us on the call for your time, for your continued confidence in us. Please feel free to reach out to your advisor if you have any other questions. And we hope you have a wonderful rest of the day. Thank you. Bye-bye.
Thank you.
Thank you.